Hello, everyone. Today we're going to talk about stock trading versus stock investing. You hear this a lot, quite often actually, but a lot of the discussions don't really address the more important parts of this topic. Um, the more subtle aspects. It's when I hear this, when I hear people talk about stock trading versus stock investing, it usually just revolves around the holding time. Like stock trading is short term and investing is long term. But that's all about it. I want to talk to you about the more important aspects of this topic so that it can guide you in your trading and investing. The first thing you need to know is that trading is like running a business, while investing is like owning real estate. This is a very important aspect that doesn't get discussed or talked about a lot, or if at all, right? Because this is really the heart of the matter, so to speak, because a lot of the decisions that you will do will be informed by this. Okay, so what do I mean by trading is like running a business and investing is like owning real estate? Well, if you trade, you it's like owning a business where, let's say you have a business, you buy and sell cell phones. Okay, you have a retail business that buys and sells mobile phones. So that is trading, right? That is trading. You trade. Like in the ancient times, they trade spices. They buy spices, sell spices, buy spices from China, and sell it in the West, something like that. Investing is like either owning real estate or maybe precious metals, like that. And then you expect it to grow in value as time goes on. So that's the main difference, is that in trading, you normally buy and sell. That is why trading has this um, people look at trading as short term, because that's how trading a trading business is. You buy a cell phone and you sell it as soon as possible, right? You don't want to sell it later because a new model might come out, and you know you can't sell the older one. So it's fast. You buy and you sell. It's short term. If you own real estate, you don't buy real estate. You don't buy land, or let's say a condominium unit today and then you sell it tomorrow or this afternoon. You don't do that, right? You buy it with the aim of holding it for quite some time, and then waiting until maybe 10 years or so before selling it. So that's how investing in real estate is, and that's how investing in the stock is. And just the same with trading. It's a daily thing. That's why there's day traders, right? There's no day investors, right? There's long-term investors, and then there's day traders, because trading is like a business. You need to have revenue daily, and in investing, it's different. And even when you look at it from a tax perspective, trading is taxed like an income in most jurisdictions, while investing, well, if it's held for more than a year, then it's treated like an investment. It has a lower tax rate. It's not treated like an income because it is not. It's not a business. It's investing. So that's it. Let's move on to the next. This is what is most often understood when talking about trading versus investing. That trading is usually short term and investing is normally for the long haul. Well, that's true, of course, but but you have to understand why. And well, the why is what I discussed earlier, that it's short term because it's a business, and businesses buy stocks or buy merchandise, and sell it as soon as they can. They don't usually let it stand for long. Meanwhile, investors buy real estate and hold it for more than a year, mostly 10 years, maybe 5 is the earliest or something, depending on what what property was invested, and the needs of the particular investor. So that's another difference. The holding period. This is the most commonly understood difference between trading and investing. Let us now talk about prices. How do traders treat prices, and how do investors treat prices? Um, in trading, of course, you look at prices. Yes, you look at prices because but you don't consider them very important, because what matters to traders is that um, the prices are rising if they want to go long. So it doesn't matter if it's expensive. If it is going to be more expensive in a few hours, or at most a few days maybe, then yeah, they're gonna buy it and then they're gonna sell it later. But in the case of investing, well, price really matters for them, because they're going to hold it for long term. So if they acquired it expensive, then there won't be much upside to that. So they want to buy really low. So price really matters in trading. If it's just like, for example, um, the meme stocks, right? GME, GameStop, right? And AMC Entertainment. Even when it was, even when their prices were high, um, the uh, especially when their prices got high, the investors won't touch those things. They won't touch because they know that the intrinsic value of those stock, the intrinsic value of each of them is low, and the price is high, so they're not going to touch it with a very long stick. Okay, but who sees uh, for a trader who sees that it's still going to go higher, even higher, then yeah, it really doesn't matter, as long as it would still go high and people are still buying it. Then okay, I'm going to buy this and sell it again at a higher price. Next is intrinsic value. For traders, they are not very much concerned about the intrinsic value of a stock. But in the case of investing, investors are very much concerned about a stock's intrinsic value. In fact, that's the whole thing. That's a huge part of investing, determining the intrinsic value of a stock. Because for investors, they want to know how much is the inherent value of a security, of an equity, and then they're going to compare that value with the selling price, with the market price, current market price. And if the market price is lower than the intrinsic value, then they consider it cheap, and they're going to buy that, especially for value investors. For growth investors, intrinsic value still matters, except that they just also take a look at the growth aspect of the company. But intrinsic value is a very fundamental thing in fundamental analysis, and so for investing also. In trading, intrinsic value is of secondary or no concern, because again, let's take a look back at meme stocks like GameStop and AMC Entertainment. People a lot of people would agree that they are fundamentally unsound because of their business model and the current business climate. It's so hard for them to grow in this current uh, market situation. So fundamentally, they are not very sound stocks. But so the investors are not going to touch it with a 20-foot pole. However, traders, even though the intrinsic value is low, they see that people are flocking. They see that for some reason, mainly because of online, because of social media, people are dashing. People are buying these stocks. So for traders, it doesn't matter whether the intrinsic value of this is good or not. If people are going crazy about it, if people are buying, then they're selling. So they buy even at a higher price, even if they don't know about intrinsic value, but they do know that people are going to buy it, so they buy it and sell it. And then if it dips again and then there's still some demand, they buy at the dips, sell again at the rally. And so that's how they don't calculate intrinsic value. They look at the trend, they look at demand and the strength, the momentum. Okay, so that's it. That's another big difference between trading and investing. Let us now go to the techniques used by trading versus investing. Traders use technical analysis. It is not only more important than fundamental analysis, but for them it is very crucial. It's the thing when it comes to trading. In investing, on the other hand, fundamental analysis is more important. The reason is that in investing, they need to determine inherent value, intrinsic value. And the way to do that is through fundamental analysis. That's how you arrive at the intrinsic value of a stock, of a security, of a company. You analyze a company, its earnings, its fundamental aspects. Only then can you clearly get an idea as to how much each stock should be. In trading, because again, we don't concern ourselves with the intrinsic value, and what matters most are things like trends, momentum, and market demand, then we look at price because that's where we see those things. And for that, we use technical analysis. But it's not only that, because in trading, as opposed to investing, timing is essential. In investing, timing is not as essential because as long as market price is lower than the intrinsic value of the security, then there's no problem. You just buy it because it's cheap. So if even if prices go down after that, investors are not really worried because they'd either hold it or they're going to buy more because it's cheaper now. If they have available funds, they're going to buy more. They're going to do what is called average down. So they buy more at a lower price, thereby bringing down their average cost. So in the long term, that would be very beneficial to them. So if it goes down again, they buy. So timing is not very important or essential to them. But in trading, well, it is very important because let's say trading is again short term. So you have to liquidate by the end of the day. And if it didn't, or if the price didn't rise at the end of the day, then how are you going to earn, right? And another problem is that if you're trading in other markets, not in stocks, but in other markets like in Forex or commodities or maybe crypto, those markets are highly leveraged, and if your timing is wrong, there's a huge possibility that your position would be closed by your broker because the market moved against you far enough to earn your margin call. Sorry. So in that case, you're going to lose, even if later it would turn out that you're right. But if you entered in the wrong uh, time, you're going to lose. So timing is very essential, and timing is provided by technical analysis. So that's why in trading, not only is technical analysis more important, but again, very crucial because of this timing aspect of it. The other difference between trading and investing is um, the types of securities or instruments that are available to you for acquisition, for trading or investing. In the case of investing, it's mostly stocks. That's what they usually invest on. In the case of trading, they have a lot of instruments at their disposal. They can trade, obviously, they can trade stocks. They can also trade bonds, forex or currencies, cryptos, options, yeah, NFT, commodities, futures, CFDs, and other derivative contracts. So they have more instruments at their disposal. The reason for this is that, again, trading doesn't care about the intrinsic value. Aside from not caring about the intrinsic value, it doesn't even care what the thing is. It could be stocks, it could be, as long as it's moving, as long as prices are rising or even falling, because you can trade short. So as long as it's moving, it's a go. If it moves, traders shoot. That's how they do it. For investing, it's mostly stocks because they're going to hold it for a longer term than traders. And imagine, let's say forex, let's say a currency. A currency doesn't have unlimited upside, so it just normally goes up and down and goes up and down. So after 10 years, you're not very much farther from where you started, because along the way it went up, but it also went down and up and down and up. Unlike in stocks, well, a stock can start at as a penny stock, less than $1, and then it could move to say 1,000 and even more, and then it's gonna have splits, and then it's gonna be 50 and go again to thousands. So there's an unlimited upside. It can go up. It just doesn't go up down. So if you find a bagger, that's what they call a bagger stocks. It's very good for investing, but you don't. There's that those things don't happen in in the forex, in crypto, in options and commodities, because some commodities, yes, like gold, for instance, precious metals, but not so much and not a lot, just a few. So that's it. So mostly it's stocks when it comes to investing. And for trading, it's anything that moves, anything that has a price, anything that's traded in a market, and as long as it's volatile and it's moving either up or down. Oh no, volatile. I mean, sorry, not volatile. I mean, as long as it is liquid, as long as it's liquid and it's moving either up or down, well, it's fair game for traders. So that's it. That's it. So now you know more about trading and investing, and hopefully it can help you in your trading or investing or both. Because right now, if ever you are in a trading mode, you know that intrinsic value doesn't matter, so you don't have to concern yourself. You're not going to miss things like GME because, oh, I'm not going to trade that because it has no intrinsic value. that's not gonna happen to you anymore, because you know that intrinsic value when it comes to trading doesn't really matter. So you're just going to ride the trend, and ride it until the trend ends. When it ends, you sell it, or you may even sell it short. But in the meantime, you can ride it. You don't have to concern yourself that, oh, I'm not going to ride this because it has its fundamentals are bad. You shouldn't think about it when you're trading. What you should be concerned of is the supply and demand. That's what matters. And this will also help you from being a victim of this thing that often happens to traders, that they trade and then it goes against them, and they become investors. They they become long-term holders. They suddenly become investors. That's a bad thing. If it's for trading, it's for trading. Don't make it an investment, because trading and investing is different, and the things that you trade are usually not the things you'd invest. Sometimes there's an overlap, but a lot of times there isn't. So don't make an investment out of a bad trade. Okay, so those who are not familiar with the difference might become a victim to that, but now that you've seen this video, hopefully that's not going to happen to you anymore. So that's it. So again, thanks for watching, and don't forget to like this video if you like it, and I hope you did, and subscribe to the channel. It will really help the channel a lot to create more videos that could be useful to traders and investors. And after you do that, don't forget to click or hit on the notification bell so that you will be notified if new videos are uploaded. So thanks again, and you have a great day.